things that is happening that is happening especially in India. Uh, Especially if you remember last couple of years, especially after COVID, we had a tough scenario, especially across the globe. Inflation was the talk of the town. Inflation across the region, across major economies as well as the developing economy. Uh, it was sticky in nature, and that is why central banks, as well as government, all across the globe had a tough time. Normally, and especially in this financial year and in the back end of 2023, we were witnessing that inflation had made its peak. Slowly but steadily, surely, both in developed as well as developing economies, inflation is slowly ticking down. Uh, this bodes well for all the economies because obviously growth, which is, because of growth is primarily driven by liquidity. And since central banks might moving forward cut rates, this is a great indication for future growth as well. Obviously, robust macroeconomic backdrop could possibly see rupee witnessing slightly, stability that we last witnessed around a decade back. RBI might look to cut rates, but obviously that will depend on how US data and how US
Fed
Fed
also.
works on.
Fed
Fed
and
and
US
US
payment interest rates, right?
right?
Very important to note
Because
because what
what
we are
we are seeing here is that since last, especially since COVID, the interest payments that because of the losing liquidity and because of the abundance of liquidity that we had in the markets, US interest payments are reaching all-time highs, especially since last couple of months. What we are witnessing is that the overall interest payments that US has in its book is roughly around 1 trillion now. If Fed does not cut rates anytime soon, it might reach $1.7 trillion, which is approx 5.7% of its GDP. However, if it cuts the rates and reduction in fiscal expenditure with interest rates, especially at, when rates are at decadal highs, it is taken as slightly negative for growth. If we especially see the last 5 years and how equities are performing across the globe, what we are seeing is that globally, across the nations and except barring some nations, especially the name of China and Brazil, markets are witnessing remarkable optimism. However, valuations are slightly on a cautious side. Obviously, Indian markets, if we see, Indian markets have performed tremendously well, which we will be seeing in two subsequent slides that why they are performing so. But obviously, margin of safety is little less in Indian markets as of now. A very important slide, if we see from the asset allocation point of view, what we are seeing and what we have seen in last decade is that slowly but steadily, financial assets are seeing some growth. Obviously, of the financial assets that Indians have, almost two-thirds is owned into all invested into bank deposits. But at the same time, equities are seeing some traction, especially owing to the benign nature of markets and COVID scenario. But yes, compared to US, which is at 35%, Indian equities roughly hold to only of around 5%. A very important slide when we, normally when we meet our investors or normally when we meet some prospective clients, generally people ask us that what about China or especially what about India versus China? If we see why, Indian economy or why Indian equity markets are outperforming, it is because of strong and steady corporate earnings. To be very honest here, the EPS growth across time frames, be it 1 year or be it 20 years, the
और क्या कहा था ये जो
Indian index has performed tremendously well. Whereas if we compare to that of China, it hasn't performed quite, the EPS growth hasn't been much. But obviously, that if we compare the valuations point of view, Nifty trades at around 23x trailing earnings, whereas the Shanghai Composite trades at 11x. Finally, to relief of a lot of analysts, Indian growth story is back. What we were witnessing or what we were actually seeing was that since last actually what happened in last 2011 was that investment to GDP ratio was somewhat, it was lukewarm in nature. But after around 12 to 13 years after that, we are again seeing, because of government's push, because of the infra push, because of the push by also private sector is slowly but steadily picking up some investments. So we might see, especially in the last 10 years, the economy has, because of the capital infusion that has happened, if we compare that with the overall inflation, overall investments that were made since investment, it comes down roughly to around $14 trillion. But out of that, around $8 trillion investment was made in the last 10 years. So that is the kind of growth that we are witnessing as of now in India. Obviously, it is not just because of the investments, or it is not just because of the growth story that we are talking about here. It is because of the both. If we compare only corporates here, all the corporates are firing all cylinders. But whether it is top line growth or whether it is bottom line growth, everything is both are actually seeing exponential growth as of now. Market sentiments as well as business sentiments remain strong. Obviously, if we see in the last 5 years or 6 years, what has happened is that the emerging markets, Indian weightage in that has increased by roughly around 10%, which is exponential in nature. Again, IMF projects that overall India's weight, or let's say India's contribution to the world GDP, might increase by 2%, which is again a very good news for Indian investors. But again, what we want to retaliate is that valuations are not cheap. Asset allocation is something which investors must to follow as of now. The main objective or the main slide of this whole presentation was that all of us know elections are going, they have already started in a lot of states. Maharashtra will also undergo elections in coming weeks. But what we have seen is that for especially for short period, markets are volatile in nature, because some way or the other, though markets are forward looking and though markets generally perform well in a long term, but due to elections, there are certain periods when markets become very volatile. Especially if we see the Sensex returns, and what we have done in this particular slide in the first table is that we have compared the returns of all the union governments since 1999. That is approx comes to near about 25 years now. Uh, Obviously, markets have performed well in all these tenures, and this is why if we compare the long-term returns of Sensex, it comes near about to around 14 odd percent. Obviously, if we see the 1 month trailing returns, or let's say the 1 month after election return, they are in nature, because obviously equities are volatile in nature, and there is no hard and fast rule that how exactly markets might behave. Because if you all might be remembering it, when 2004 elections happened, because NDA was, the ruling party, and it lost power, markets fell. In 2014, however, UPA government was the incumbent, but they lost. But because of anticipation of Mr. Modi's leadership, there was a pre-market rally. What will happen now and what is happening now? Markets are consolidating a bit. This might be because markets have already, because of in November, December, when 5 elections happened in states, and because the ruling party was seen to be winning them all or performing well in elections, uh, slightly negative trend in prices is seen since last 1 week before People's Time, but for all markets are nominal now. So over to Tushar sir now. Thank you.
Thanks a lot, Siddharth. It's a pleasure to be here again on a nice occasion of discussing about ballots and markets. It's interesting that Siddharth made this point about the longer term returns of equities, regardless of what happens in an election. So, Siddharth, if I would request you to just go back to that slide, we can start off with just discussing what has happened in markets So as you notice here, there is not much of a difference whether a BJP government came to power or a Congress government came to power or BJP government got re-elected. If you can see that the 5-year period, so the entire period of which the government runs, there is some commonality in terms of the total returns. Yes, in some cases, for example, the first time the UPA came back in the year 2004, the market really rebounded dramatically because of the hope of a significantly higher rate of reform, which was associated with the then Prime Minister Manmohan Singh, because he was the first Prime Minister which actually created the reform agenda in the 1990s. So when he got re-elected in the 2004 year, they thought that the dream team was back, and that led to some hope of the economy doing well, etc. After that. But as you can see, over time, if you take an average of the returns here, they're more or less in the 70 to 80% range over a 5-year period on an absolute basis. So you're almost doubling your money in 5 years, which is around 14%, 14.5% compounded. And in this case, it is between, in a year which was 100% over 5 years, it is around 14.5%. And in a year where it was 60%, it is around 12% compounded over the period of 5 years. So as you can see, there have been various periods which have elected different governments, but on an average, you can see that the returns more or less are around the same. So it is easy to conclude from this upper part of this table alone that markets really don't make too much of an election or too much of a certain government coming to power or certain government not coming to power. Now, if you look at the bottom half of this table, it is basically giving you some data around what happens 1 year prior and 1 month prior to the election, and 1 year after and 1 month after the election. So this is an interesting table where you will get some sense of what is likely to happen even now. So again, the same elections, the same periods are taken here. So as you can see, before the 1999 election, where the NDA came into power, 1 year prior to that, there was a 50% gain in the market and a 3% gain in the last month before the election, with an expectation, I don't know of what. And then the election happened, and the BJP came to power. The 1 month after that, the market fell 13%. So you can imagine that the market didn't like the verdict, and they really had a very bad time. So 13% down in 1 month. However, by the end of the year, it had recovered, and it was only down 0.8%. So as you can imagine, this election did cause some dramatic change for the short term. But we all remember that after the election, for the next 5 years, it almost provided us returns of around 12 to 13% compounded for the next 5 years. So that's just to put in perspective. Now let's look at the next election, where the Congress came to power, and it was 100% return almost prior to that year. So you can imagine that most of this 86% return came in the last year of the erstwhile NDA government. So as you can see, there was a range of returns. So while they did not like the situation in right after that election result came in, like within a month, they destroyed it by 13%. The last year of that term, of the same term, which they didn't like in the first term, gave almost 100% return in the stock market, right? So they were expecting that the NDA is likely to come back, India shining. I don't know, some of you may remember those times that it was almost a given that the BJP was going to come back and Mr. Vajpayee was going to be re-elected again. But before the election, 1 month prior to that, I think the market sensed that maybe there was something wrong here, and it gave up 7.5% of the gain. in just that 1 month prior to the election. After the election, there was a surprise that the UPA came to power, and remembering that, in the past, the UPA governments had given us good returns. The market in 1 month alone went up 23% in 1 month alone. But by the end of the year, the whole return which they made in 1 month was lost, and actually the year ended by a minus 14.4% return for that year, 1 year after the election. So you can imagine that there is tremendous volatility given the expectation of what is likely to happen and what eventually happens in the first year, and then what eventually happens in the 5-year term over the period of the new government. And the same thing, you can trace in all of the others, where when the UPA was ending its second term, the last year of its term, the market was down 25%. They really kind of did not think that this government was going to do anything. If you remember, there were lots of scandals at that time already. But before the election, the 1 month prior to it, the market went up 26% in just that 1 month, expecting, whatever the market was expecting. And after the election, within 1 month, the market again went another 31% up. However, by the end of the year, it was only about 6.8% of the whole year review. So you can imagine there was a lot of uncertainty during this period. And the expectations of the market really were driven by where it went over this time. And then came Mr. Modi. So the first time that he got elected in the year 2014, 1 year prior to that election, I think everything was going well. The market had given a 16% return prior to the election for that year. Even in the 1 month going into the election, the market was up 8%. After the election, the market went up 20% in 1 month alone. And I think, again, you must remember the time that the shift in the government happened. Achhe din, there was a feeling that there were going to be a dramatic change from the previous government's policies, and there was a lot of hope. And that led the market in the 1 month alone to go up by 20%. It gave up most of its gain by the end of the year. So the market was up 7.1% by the end of the 1 year after the election in 2014. 2019 was a slightly different year in the sense that if you see the range, see here what we are talking about is very significant 1 year prior gains or 1 year prior losses, and very, very significant change in the markets in the 1 month following elections, etc. You can see a lot of volatility in the first 4 elections. In the last election, however, in the 2019 election, it was really not that much of a great year in markets coming into the election. Even the 1 month going into the election, it was just about 0.5% that the market was down by. And after the election, actually that next month, it was down 2.5%, 2.8%. And for the whole year, it was just flat. So as you can see, there was hardly any volatility around the election in 2019. So what we are seeing here is a picture which embodies the kind of expectation that markets have from governments and what they're likely to do, and that rides the sentiment too much. So in the short run, the markets display this sort of expectation, disappointment, whatever you can call it, prior and post the election, driven by what they anticipate that the government is likely to do and which government is likely to do what. And because we don't know the outcome of the election and the range of outcomes that come in based on the majority that any government manages, the volatility continues. So the first thing to establish for ourselves is that, does the election have any impact on the markets? If we see the hard data, which is what we've seen now, for the years 99, 2004, 2009, and 2014, yes, there was a lot of volatility around the election. Even before and 1 month after, there was either a very sharp fall, like in 1999, or there was a very sharp upturn, which was almost 20-30% in size in the 1 month just after the election. So what should we expect for now? Now, as we can see, 1 year coming into our market. So for example, if I were to say, let's now roll this for 2024 and say, what has the market done for 1 year prior to coming here? I think the market has done very well. I think it's upwards of 30-40% on the Sensex that we've seen. What has the market done for this 1 month? This 1 month has been fairly flat. It's not really been too much of an exciting story. What will happen in the 1 month after and the 1 year after is a question mark for all of us. And if history has to tell us everything, that over a period of time, and then I bring you back again to the first table on this chart, which is the upper table, that over the time, no matter what happens to the market immediately after the election, a month after or a year after, it is not reflective of the overall return that one can expect over the next 5-year term. And especially when we talk about equities, one should always talk about the fact that you're talking about long-term return. So the question in everybody's mind is, should I take money off the table because I've made some money over the last 2-3 years and then wait for the election result and do what? So the question I will ask every investor who waits is to say, are you expecting the market to fall dramatically so that the profits that you've booked can be redeployed at a lower rate? Or are you expecting the market to remain flat? Then there was no reason to sell it in the first place. Or do you think the market will go up from here, in which case you will have made a mistake? So the outcomes that we're talking about, when people say that I want to take the money out of the market, should be, if at all people do that, should be driven by only the fact that they expect the market to fall. Now, let us look at the fact that the markets over the long term, are they driven by election outcomes or are they driven by corporate earnings? Because in the long run, the markets doesn't really look at electoral results or who is in government at all. What they are really interested in is that the companies that they invest in, what kind of earnings growth are they representing? And if they are going to have a significantly higher earnings growth, then the price of the market, which is what we call the Sensex level or the Nifty level, is only a multiple of that earnings growth, right? So in that sense, I think it is very important to remember that our asset allocation in these asset classes, whether it is equities, whether it's fixed income, whether it's real estate or whatever, should be driven with our expectations of how long we hold them and what is the expected return potential for the term of the investment. Now, equity is very easily, it is very well known that equities return a significantly higher rate of return over any asset class over longer periods of time. So you have to compare longer periods of time, at least from 5 to 10 years as a minimum. And even if markets have done extremely well in the past 2 or 3 years, if your term for investment is around 5 years, I don't think you need to change your asset allocation dramatically just because an election is there and there is a possibility that post-election the market may come down. There is no reason to change that asset allocation at all for that reason alone. And here I'm talking about largely the large mass of savers who are allocating to equity for generating growth in their wealth over the next few years. Yes, there are certain experts who time the market, or they think they can time the market, knowing that either the market is expensive, so I sell out, and the market is cheap, I come back in. There are these mythical people who supposedly know when to come in and go out. I have yet to come across someone who has timed the market every time 100% right, which means that there is a very large error term and you can go wrong when you try to time the market. And if you do go wrong, there is a significant chance that you may lose a lot of capital. So I think all of these things have to be taken into context and to realize that first of all, what we're establishing is that the elections over long periods of time, whether it is one government or the other government, unless the government really screws up. Now, again, that is a small probability. But I think over many years now, what we have realized is that Indian governments have grown up. The Indian economy has matured. And most of the very hard reform which was required in this country, whether it started from reforms in the banking sector. If you remember, we had significant constraints on lending and borrowing. I don't know if any of you remember that there used to be a certain rate of interest which was fixed by the Reserve Bank of India for lending. and for borrowing. Now, can you imagine that that was, the situation about 30 years ago? And 1991 was the first time that, the economy said, because of such a constrained regulation, we are unable to lend to people at rates which are really useful for people to borrow, and the cost of money just remained significantly high because of that. So once we deregulated interest rates, once you allowed banks to lend and borrow at a rate which they felt was the market rate, suddenly the market exploded. And we saw that our lending expanded, our banks became much larger when they were. Private banks licenses were issued, and suddenly we had a dramatic change in the financial landscape following what is known as reform. Now, most of this reform, I would say the larger chunk of that reform over these many years has already been effected. Whether it is, free flow of capital in and out of the country, whether it is interest rates, whether it is what we call as reserve ratios. Earlier, the government used to be extremely conservative and ask banks to have a very large reserve kept in their capital, so that in case something happens, they would always have the money. I think the economy has matured enough to know that banks don't really lose their capital so dramatically, so they don't need to require to have such a large reserve kept in the banking balance sheets. That reserve requirement having become lower allows the bank to lend more, and when they lend more, they make more money. So the profitability of the banks dramatically changed after that change in regulation, etc. So all I'm trying to say is that if in the past the volatility was around an electoral outcome, it was largely to do with the expectation of what the government was likely to do as a result of the mandate it has got. So if the mandate had been given to one party or the other, there was an assumption that the market used to make that as a result of which they will do this reform, they will not do this reform, etc. And the expectations were expressed in the way the market went up and down. But if you see the last 2019 result, I think it is more symptomatic of what is likely to happen. And that's my guess, because if you look at the expectation of reform, now everybody knows that mostly the largest reform is over. So essentially what we're talking about is the next step of reform, which is incremental, which is marginal, which is not likely to happen right away, etc. So which means that from an electoral perspective, I think everybody assumes that the ruling party is probably likely to come back to power given all of the opinion polls prior to the election, etc. And they will continue the reform agenda that they've had, and that it will not lead to dramatic change in the corporate environment, because ultimately, how are the markets affected? Is that if there is any change in the way the corporates operate in any country, whether it is taxation, whether it is regulation, whether it is taxes, whether it is some kind of restrictive practices the government imposes, then it limits the ability of a company to make money. And essentially, once the potential for a company to make money in a certain regime was X, and if a government comes and starts restricting that activity, then the profits start to dwindle. And as a result, the market may react. But I think we are now past all of those situations where there will be any draconian reintroduction of laws which restrict free and flow operation of business activity in our country, whether it is the Congress, whether it is the UPA, whether it is the NDA, or whether it is any other coalition of whatever may be imagined. I don't think the ruling party or the ruling governments now realize that they have any choice but continue the process of having an open market like what we've had for the last maybe 10-15 years. It will have to continue. So which means that the elections now mean less and less, given the fact that the economy now is pretty much on its own steam. That the government doesn't direct economic activity in any way, which it used to in the past. And as a result, the election really now becomes more or less just a historical fact, and could be more or less described in the last election outcome, where there was hardly any move 1 month prior and 1 month after. There was generally a gradual decline over that period, but it had nothing to do with the electoral impact as such. So I think in short, what I'd just like to end with is saying that the ballot effect on markets one should now expect it to be less and less as we go forward. And if you remember in the US, for example, where there is an established economic framework, which is not given to any new government coming and changing it in any way, the companies continue to perform and act regardless of any change in the government. There, if a Democrat president comes or a Republican president comes, there is some changes in levels of taxation which they expect. And typically the expectation is that the Republicans are tax friendly and the Democrats are tax unfriendly. But also on the other hand, the Democrats are supposed to be a lot more liberal in their outlook, and they provide for more handouts, as they say. And the Republicans generally generate more business activity. So that is where the US elections are more or less gradually coming to. I don't think we have any such thing in India so far. I think both the parties, the large masses of parties that we have, the NDA and the UPA, for example, they are largely pro-business. I would think that the BJP is probably a little bit more pro-business than the NDA. But the NDA, again, I would say is a little bit confused in terms of what it has as an agenda. So one cannot make any call on what they are likely to do or not do. But I think it's very clear that if we do have the same ruling party come back, which is again, as most people expect, then we will have more of the same, which again will lead to the fact that maybe the election will not have much of an impact at all on the markets. And the focus will again come back on valuation, on earnings growth, and essentially the fundamentals of why the market moves one way or the other, and not because of the external factors such as the elections at any point of time. So I hope you were with me throughout this conversation. So it's easy for me to conclude with that sentence, but very happy to hear from you, anyone, if you have any questions regarding what I said, or generally just anything that you would wish to know about the markets right now, of what I can explain, that is. Thank you so much. Thanks, Abhishek, for the opportunity. Thanks, Epsilon, for inviting me for this conversation. Really happy to be here. Thank you. You can also mention it in the chat. If you have any question, you can type that out, or you can unmute yourself and ask the question.
Hi, Tushar. Good morning.
Hi.
Just one question on the commodity side. We are seeing basically gold rising, and we are seeing China going on a berserk in terms of buying of gold as a commodity. And if you see the YTD returns of gold, it is outclassed or any other asset classes. What's the outlook? Because I understand this year has been a very tricky year in terms of very uncertainties across the globe, elections, war, everything, right? So what's the outlook for gold for this year? Do we continue to advise customer that you can still have an asset allocation with a higher allocation to gold for this particular year? What's your view on that?
Thanks, Nitin. I think, see, I mean, when we take commodities, for example, we have to classify them into industrial commodities and precious commodities. So I think industrial commodities are a function of the economic activity which is expected in any year. In fact, what we are talking about is one of the charts that Siddharth shared was that inflation is coming down. One of the reasons why gold becomes an allocative asset in most of the investment portfolios is that they are worried about inflation. Essentially, gold as an asset class is called a inflation hedge, because you know that no matter what happens to the financial markets, where currencies go, gold kind of continues to hold some value no matter what happens. So it is a preferred asset class at times of economic turmoil. So if you remember the last time gold got crazy, that was a time that we had the financial crisis. So in 2008, 2009, gold prices dramatically improved, and they almost touched $2,000 per ounce, if you remember. After which, once we thought that the economies and the financial markets were coming back to normal, gold had a big fall after that. And it has taken so many years back again to come to this level of $2,000 plus for the gold to actually come. Now, there are 2-3 things why gold has become very popular last year. And again, I'm talking anecdotally. I haven't checked the data myself. But I am told that central banks all over the world are worried about the fact that China as a nation is trying to secure gold reserves for itself. Either because it's one of the largest consumers of gold anywhere in the world. If you remember, like India, where we also have tremendous demand for gold, but for personal use and for jewelry, etc. China also has a very large mass of consumers who buy gold on an annual basis. So they're worried that the gold price and the gold reserves, which are controlled elsewhere in the world, for example, the largest reserves of gold are with the United States. They worry that the price of gold will, create a little bit of a compromise on their part. And as a result, they are starting to increase their gold reserves. Is the anecdotal evidence that we have. Anyone entering the gold market with such a large appetite of trying to build reserves to kind of compete with the US, for example, will drive the gold price the way it is. Because gold, if you remember from a physical perspective, is very short, small commodity. It is really very well matched in terms of demand and supply. Any significant incremental demand for that metal makes the price go up dramatically. As a result of which, you have to remember that it becomes what is known as a speculative asset class. It is not a safe asset class. Why not safe, according to me, is because gold doesn't generate any interest income. It doesn't generate any profits. It doesn't generate any dividend on its own. It is just the price that you buy, and that price is determined by demand and supply. And at the time that you will sell, the price will be determined by demand and supply. Now, in the last year, the demand for gold has gone up for the reasons I mentioned. Tomorrow, if the Chinese government says, look, I've got enough, and there is no big buyer in this market, everyone will turn a seller as well, because all of the speculative activity will go out, and they know there is no incremental buyer in this market. So you know what happens when such things happen. So at best, to give a short answer to your long question, it's actually the reverse. But I would say that gold should be allocated by investors only to the extent of their liking, to their understanding of how gold prices move, and to the ability of keeping your portfolio a little undiversified, in the sense that I won't say undiversified, uncorrelated, because most of the financial assets, they are all correlated, and gold is uncorrelated. So if you want to keep a little safety and saying that, look, I don't want all of my investments in financial assets, and I want something uncorrelated, I might want to allocate something to gold. And that would be my answer to that. So after having such a large run, will it continue to have significant gains? My question back to you then is that, do you think that Chinese gold demand will continue? If the answer to that is yes, then the gold price may go up. But as I mentioned, it is at the risk of the fact that when the Chinese buying will end, there will be nothing else. So I will just recall again the time that when China started to buy every possible commodity in the world, which was in the year 2003 onwards. And it had led to a general expansion in the global economy because of this China buying. After 2008, when the whole collapse started, there was a tremendous contraction in the global economy because China stopped buying so much as it was buying. So it can create these kind of disruptions in the market. So I would be a little wary of trying to estimate where the price of the gold is likely to be. So I hope I answered your question.
Yes, Tushar. Thanks. Thanks a lot.
Thanks, Nitin, for your question. And we've got a question from Arindam Datta about the range of Bank Nifty, mainly PSU banks, from now to till 1 month post-election. Now, this is a question clearly not directed towards me because I have no idea. What happens in 1 month? Not only I can claim that I don't know, but I am sure nobody knows. because these are driven by, extremely short-term events. And essentially, when I talk about the PSU banks, etc., you have to remember that their sweet run in the last 1 year or so has been for various reasons. Of course, the fact is that they are coming off of a very, very good period where most of their bad debts now are written off. There is a progressive nature in terms of most managements there. And there is a lot of autonomy which the RBI has given to these banks to operate in. As a result, it translates into higher valuation or a higher multiple. They have always continued to make money, but they trade at lower multiples than private banks because the autonomy that the banks have and the ability to move and their managerial capacity was always under question. I think that is changing a little bit at the margin, and that's why we've seen a significant run up in the prices. And that is basically a re-rating of the PE, and it is not because the earnings growth is explosive. So if a bank price, stock price has gone up 100%, it has not gone up because the earnings have gone up 100%. It is because if it traded at, say, 7 times and then the earnings came at 25%, it re-rated from 7 times to 10 times. And that itself doubled the price. That is the reason why you are seeing the returns in the PSU banks. Now, can they trade at 10 times and make you more money as in earnings growth? I think the earnings growth largely across private banks and public sector banks are largely going to remain probably in a range, no significant up or down. And the question to ask is, do you think that the re-rating in public sector banks is going to continue from here? So can 10 times go to 12 times or 15 times? That is a question that one has to answer for themselves. And I feel that that is a question for everybody to consider, to say whether PSU banks will do well or not. But since your question is 1 month from now till 1 month post-election, I will humbly submit to you that I have no idea.
Sorry, Tushar, just one more question from my side. Let me take this liberty. Any sector on which you have a contrarian view, given the situation where we are? Maybe a sector where you were underweight, or you were not that much bullish, and now you see an opportunity maybe on a contrarian side.
Okay. Let me upfront talk about this, saying that I have some views on the other side. That is where everybody is excited and I am not. But there are hardly any sectors now which are kind of undiscovered, as you are saying, that what everybody is not very positive about and that I'm positive about. There has been a tremendous rotation in terms of how most of the sectors have got re-rated over the last 1 year or so. So the frank answer is that there are not too many pockets of undervaluation as a sector. But there are pockets of undervaluation as companies go within the sector. That becomes extremely stock specific. But I can't recall of any one sector that everybody is totally given up on, and I feel that there is some opportunity. If you take banks, for example, the biggest question people are asking is about, and I'm saying this name only because it's there in the news recently. I have no interest in it, nor I want to push this stock in any way. So that is the caveat there. Kotak Bank, right? So it has fallen significantly from some time back. And people are saying, oh, is this a time that everybody's given up on this, that you can make some money here? I think clearly, yes, but not in the next 1 month, not in the next 1 year. But I think the time that you enter into any stock, it is after a very significant, a steep discount from its average valuation, you always make money. And I'm not saying this about Kotak Bank. I'm generally saying this about any stock. But you have to understand that the term that you will be investing in it for will be significantly higher. And the fact is that these disappointments may start getting reflected in the numbers. Say, for example, there is some estimate about the impact of what the RBI has asked Kotak to do or not do will have a significant impact on its earnings. Now, how significant will it be? Will it be any more significant than what we are estimating at this time? Is where the stock price will move in the near term. That is how sentiment will drive it. But over time, if you think that Kotak Bank is here to stay, that it is a very significant portion of the banking landscape, and that over time it will recover, then I think buying at these multiples might, make it more reasonable to look at. So coming back to this question, are there any significant sectors that we have ignored? I can't come up with even one. Mayank is asking, what do you think of the future of small finance banks? What is the essential ingredient for them to keep up with the big banks who are entering the rural and semi-urban space very aggressively? So as an individual opinion, I think the small finance banks are in a good place. That is because they are serving the underserved. So essentially, they're expanding their market in a place where the larger private banks don't exist. And by virtue of some of them being microfinance companies prior to that, they know the clientele, they know the region well, so they can bank well in those areas. And I would think that they're in a good place, but obviously not all of them. So you have to be selected. And of course, the fact that some of the companies do trade at a significant premium. So you have to take all of that into consideration. But I think they are in a good place. Mr. PM Srivastav is asking the election effect on IT sector, positive or negative? That's an easy question to answer. The elections really have not much on the IT sector at all, because the IT sector, the largest clientele is outside of India. So the election, whether this way or that way, really has no impact on their earnings. Their earnings actually come from selling investor IT services to companies abroad. So that is either largely the US or the UK. So in fact, elections in the US may have an impact on IT sector's earnings, because if immigration policy becomes very tough, and as you know, IT sector in India is largely driven by the immigration of H-1B visa company personnel who go into the US and provide services at a lower cost. If there is some damage to that model, then it may have a negative impact in the near term. But with the kind of services which are delivered now, which doesn't require you to be physically available or stationed in the US, that risk is starting to come down. But if at all, the election in the US might have a bigger impact on IT sector than the election here in India. So I hope I answered that question as well. With that, I would think I've come to the end of my interaction. Over to you, Siddharth, for some closing comments and the last slide.
Thank you, sir. Thank you for your time. Thank you, everyone, for joining in this call. As a parting thought, just this slide for you all. In short term, to summarize what Tushar sir mentioned, that markets are volatile. There will be politics, there will be various opinions, headlines. Markets might go there, markets might move there. But in the long term, just exactly like a seesaw, you should put your weight on asset allocation, on how you can increase your savings rate so that you can, for your retirement corpus or for different future needs, you can have a sizable corpus ready in your kitty. So yeah, that's it. Asset allocation is not just a cornerstone. It's the foundation of every successful investment strategy, timeless or indispensable. Thank you for your time. We will be uploading this video in our social media sites as well. So do connect with us. We will be coming back to you on another monthly call next month, where elections might have already happened, and we might be seeing certain outcomes of how markets are and how overall asset classes are reacting to it. So thank you. Thank you, everyone.